This is David Russell, Global Head of Market Strategy for TradeStation. And today we'll look at major events for investors and traders. Large growth stocks are leading the market to new highs once again, as investors look for interest rates to move lower. The S&P 500 rose almost 2% in the holiday-shortened week between Friday, June 28th and Friday, July 5th. The index closed above 5,500 for the first time, and the Nasdaq 100 closed above 20,000 for the first time. Big growth names like Tesla, Apple, and Meta platforms helped drive the move that offset weakness in the broader index, where 61% of members lost value. Important data points suggested the economy is slowing, with the potential to reduce inflation. Consider these points. Unemployment unexpectedly hit a 2.5-year high of 4.1%. Job growth in June beat estimates by 16,000, but April and May were revised lower by 111,000. Next, hiring focused on non-cyclical areas like healthcare, while economically sensitive areas like manufacturing and temping shrank. Initial jobless claims were slightly above estimates, and continuing claims rose to the highest level since November 2021. Next, the Institute for Supply Management's service sector report unexpectedly dropped to a 4-year low. Its manufacturing index also missed estimates. Both reports showed slowing price pressures. ADP's private sector payrolls report showed the smallest wage increases since August 2021. Federal Reserve Chair Jerome Powell said at a conference in Portugal that inflation now shows signs of resuming its disinflationary trend. Minutes from the last central bank meeting added that a variety of factors were likely to help contribute to continued disinflation in the period ahead. The Atlanta Fed's GDP Now, which provides a running estimate of growth, now sees the economy expanding just 1.5% in the second quarter. That's down from 4.2% in early May and 3.2% in mid-June. CME's FedWatch tool showed a September 18th rate cut more likely. The market is also more optimistic about a second reduction in December. In addition, the yield on 2-year Treasury notes fell to their lowest level since the beginning of April. Those are more sensitive to Fed policy changes, so they reflect market expectations of a cut. Now let's check out Tesla. The EV maker had its biggest weekly gain since January 2023, after quarterly deliveries beat estimates. Investors also focused on its potential as an AI stock, with Elon Musk expected to unveil autonomous robo-taxis on August 8. The rally made consumer discretionary stocks the top-performing sector last week. Technology was the second-best performing sector as chip makers bounced. Software companies, which fell sharply in April and May, also continued to rebound. Communication stocks took third place as Meta, Alphabet, and Netflix jumped to new highs. Paramount rallied after CNBC reported that a takeover might come soon. Meanwhile, cyclical groups like energy and industrial stocks fell. Some investors might think that the kind of conditions we saw before inflation surged in 2022 are returning. Gold and silver miners were the other big gainers last week. They're often viewed as potential beneficiaries of Fed rate cuts. And now let's chart the market. Last week began with the S&P 500 consolidating above 54.47. That was a high from June 12, where it had bounced several times. The index briefly tested that level on Monday morning and held. It rose slightly on Tuesday and accelerated higher through the remaining sessions. The S&P 500 has now gone 454 days without a 3% pullback. That's the longest streak in almost 9 years without such a drop, according to TradeStation data. Such tight price action is potentially consistent with a lack of selling pressure and significant cash on the sidelines. Some indicators behaved similarly to the period in November and December when the current rally began. For example, the Relative Strength Index, or RSI, remained at or near an overbought reading. The 9-day rate of change also stayed positive. Next, the yield on the 10-year Treasury note returned below 4.32%. That was a potentially important level from June 2008. A pair of firms, Comerica Wealth Management and Carson Research, made bullish predictions based on the strong first half of the year. Interestingly, a survey by the American Association of Individual Investors showed bullishness falling as the market advances. That may suggest that sentiment remains nervous and hasn't yet reached a period of complacency. And now let's turn to the week ahead. It has two major economic events and the start of earnings season. The first item is tomorrow morning when Jerome Powell testifies before the Senate Banking Committee. Investors will closely monitor his comments for clues on monetary policy. Crude oil inventories are on Wednesday. Thursday morning features the Consumer Price Index, or CPI, at 8:30 Eastern Time. As the first reading of inflation in June, it's likely to have a big impact on interest rates and sentiment. Initial jobless claims are also due, along with quarterly results from PepsiCo and Delta Airlines. Friday brings producer prices, plus earnings from JP Morgan Chase, Citi, and Wells Fargo. Thanks for watching. Please visit tradestation.com for more.